So banks and mortgage lenders know that come renewal time, they can offer you a higher rate at renewal because the legal expenses to move to another lender are going to cost you just as much. That's bullshit. Hey everyone, Conrad Neufeld here, and today we're going to be talking about 5 things that you need to know can affect your rate that you'll receive when you go to renew your mortgage. Okay, so you've been living in your house now for a few years, the existing mortgage that you have on your home is about to expire, and you're going to need a new one. Now what? Well, about 4 to 6 months prior to your current mortgage expiring, your bank or non-bank mortgage lender are going to send you a mortgage renewal agreement. And in it, it's going to outline a variety of options that they have available to you. So the first thing that you need to know is it's likely not the bank's best rates. Now you might be saying, Conrad, I have banked at this bank for 15 years. I know I'm getting the best rates. But you're probably not getting the best rates for 2 reasons. The first involves something called a fiduciary duty of care. In this context, the fiduciary duty of care means whose best interest someone has to consider when helping you get your mortgage. In this case, the bank employee has a fiduciary duty of care to the bank. And logically, this makes sense. What the bank is selling you is a financial product, and they need to make a profit. After all, they're not a charity, and they've got shareholders and investors that they need to make happy. Mortgage brokers, on the other hand, have a fiduciary duty of care to you, the homeowner. In other words, if they're going to assist you with your mortgage, they need to make sure that they are properly taking care of your best interests. This is one of the reasons why, come renewal time, you should have a mortgage professional that you trust review your mortgage renewal agreement, because they are legally required to have your best interest at heart. The second reason that the offer that you received is likely not the best out there is that banks know that around 80% of people are going to sign that renewal agreement. In fact, most people aren't even going to go check to see if they could have gotten a better deal elsewhere. So stop and think about this for a second. You know that banks are going to operate in the best interest of the bank, and you also know that most people aren't going to double check the rate that they're being given on that renewal agreement. What do you think the odds are that they're giving the best rate on that renewal agreement notice? So yeah, it's probably not the best rate out there. So have your mortgage renewal agreement reviewed by a mortgage professional. The second thing that you need to know is that even if a bank or mortgage lender is truly providing you the market best rate on one of their terms or mortgage products, it doesn't necessarily mean that that term or mortgage product is a fit for where you are at in your life. For instance, your bank might have a great 4-year fixed rate, but is that really what suits your needs best? I mean, maybe it is, but it's also possible that it's not. I was reviewing a mortgage renewal one time for a homeowner, and the client came to me and said, hey, you know what? My bank has showed me this 4-year fixed rate, and it is a great 4-year fixed rate. And it truly was. It was a great rate for the 4-year fixed product. But I was like, well, aren't you moving in 2 years? And he's like, yeah. And I was like, well, then why would you ever lock yourself into a 4-year fixed mortgage and put yourself in a situation where you're likely going to have to pay penalties? It doesn't make sense. So that's a case where they truly did offer a competitive product, but it didn't align with his life and home ownership goals. A mortgage renewal is a great opportunity to review what your life might be like in the next few years. And the mortgage that you had before isn't necessarily the same type of mortgage that you need now. Focus first on finding the mortgage that's going to properly fit your needs. Then go ahead and find the bank that's going to provide you with the best rate for that mortgage. The third thing that you need to know is that banks know more about mortgages than you do. And oftentimes, the things that you don't know are the things that are going to cost you. A rising trend, for instance, is that some banks and mortgage lenders are registering your mortgage on title with an unnecessary collateral charge. So what is a collateral charge, and why would you want to avoid it if you don't need one? When a bank goes to register your mortgage on title, there are 2 main ways that they can do it. The first is with a standard regular mortgage charge, and the second is these collateral charges that we're talking about. But these collateral charges differ from regular mortgage charges in 2 main ways. The first is that they're readvanceable. That's why anybody who has a home equity line of credit has a collateral charge, because the home equity line of credit needs the readvanceability that that collateral charge offers. The second but more important difference here, though, is that collateral charges cannot be assigned, switched, or transferred to another lender. What this means come renewal time is that you don't have a mortgage that's registered on your title in a way that's easily transferable to another lender. In fact, in order to do so, you're going to have legal costs in order to transfer over to that other lender. So banks and mortgage lenders know that come renewal time, if you have a collateral charge, they can offer you a higher rate at renewal because the legal expenses to move to another lender are going to cost you just as much. Now, I'm not saying that any bank that's putting a collateral charge on your mortgage is trying to rip you off. But if you have some bank rep telling you that they're going to be putting a collateral charge on your mortgage because someday you might want a home equity line of credit, that's bullshit. There's absolutely no reason why you should be putting a collateral charge on your mortgage now if you have no intention of having a home equity line of credit or even the possibility of a home equity line of credit within the term of the mortgage that you're signing now. And I know from professional experience that there are some homeowners that have gone back to their banks, fought for that better rate, only for that new mortgage to be registered as a collateral charge. Because if banks can't make money on you now, then they have to at least try to make money on you later. Because if they can't, then you're not an asset, you're a liability. The fourth thing that you need to know is that banks and mortgage lenders aren't just reviewing you at the time that you get the mortgage, they're actually evaluating you now throughout the life of that mortgage. Most banks keep that evaluation relatively light throughout a majority of the mortgage. In fact, if you're paying the full mortgage payment at the agreed upon times, most banks won't bother to even check up on you. But come renewal time, before offering you that mortgage rate, most banks are going to check your credit. And if anything of note has changed since you first got that mortgage, or if they see or perceive that there might be an issue going forward, you might see a reflection of that in your rate. Or if it's bad enough, they may choose to not even offer you a renewal agreement in the first place. Lenders are also becoming a lot more sophisticated in being able to understand notable changes in your employment that might change the risk rating that they would apply to you, and thereby changing your rate. So while there may be things that are out of your control, you should be doing everything that is in your control to make sure that your financial house is in order, because it could affect you come renewal time. The last thing that you need to know is something that affects you but you have no control over, and that's changes in regulations can affect your mortgage rate. 5 years ago, for example, homeowners in Canada may have opted to put 20% down and avoid paying CMHC premiums. But changes to the B20 and B21 regulations in 2016 and 2017 meant that those that were bulk insured or uninsured now are a higher risk rating to the mortgage lenders. So there was a period there where come renewal time, these mortgages were seen as higher risks and they were being quoted higher rates. So not everything is under your control, but you're definitely not helpless either. So have your mortgage renewal reviewed by a mortgage professional. That doesn't mean that you have to go with them, but at least know what your options are and get that second opinion. If you've made it this far, thanks so much for watching. Please consider subscribing, hitting the bell notification so you're alerted when I come up with new videos, and liking and sharing this one. Until next time.